Welcome back to the Deep Dive. We are your daily intelligence briefing on the digital asset market, and we are in a very strange place right now. We're looking at the last 24 hours, December 23rd into the 24th, 2025.
It's been a really frustrating period if you're just watching the price, because you have these two massive forces pulling in opposite directions.
Right.
On one hand, you have, incredible structural adoption happening all over the globe, new rules, new infrastructure. But on the other, you have this tactical money just flying out the door.
And it's driven by what you've been calling a liquidity paradox.
Exactly. Good news for the U.S. economy is somehow turning out to be actively bad news for Bitcoin.
Okay, so that structural friction, that paradox, that's our mission for this deep dive.
Right.
We need to figure out why Bitcoin is just stuck. It's consolidating in this really fragile band between, $86,500 and $88,000?
And it failed again.
Yeah.
It just cannot seem to reclaim that $90,000 level.
That big psychological barrier. So the question we have to answer for you is, are these headwinds just some year-end noise, or is this something deeper?
I think to get to that answer, we actually have to start outside of crypto. The main driver right now isn't coming from within the ecosystem. It's all about the traditional economy.
All right, let's go there. We always hear this phrase, good news is bad news for assets that need cheap money to run. But let's look at the actual numbers that came out on the 23rd.
It was a shocking beat, really. The consensus for Q3 GDP, everyone was looking for something around 3.2% annualized growth, which is already pretty strong.
And what did we get?
We got an explosive 4.3%.
Wow. That is a huge outperformance. So where did that come from? What was driving it?
Well, it wasn't just, inventories or government spending. It was really the American consumer. Personal consumption expenditures, or PCE, surged 3.5%. The U.S. consumer is just spending.
Okay, so if the economy is that strong and we're seeing the S&P 500 hit record highs, why did Bitcoin sell off? Why did we get this decoupling?
And that is the absolute core of the paradox. The market is not trading on growth. It's trading on what that growth means for liquidity.
Right.
This kind of economic resilience, it's a huge signal to the Federal Reserve. It tells them they have absolutely no reason to start easing monetary policy.
So all those hopes for aggressive rate cuts in early 2026.
They're basically off the table for now. The argument for flooding the market with cheap money has been neutralized.
Can you just make that connection super explicit for us? How does the Fed keeping rates high actually hurt Bitcoin's price right now?
So when the chance of lower rates disappears, the 10-year Treasury yield goes up. And that yield is, basically the risk-free rate of return on your money.
Okay.
As that risk-free rate gets higher, the opportunity cost of holding something that doesn't pay you anything like Bitcoin or gold, it just gets more and more expensive.
So why hold a volatile asset when you can get a guaranteed return from a treasury bond that's suddenly looking a lot more attractive?
That's it. That's why you saw that immediate selling pressure hit the market.
And it wasn't just the growth numbers. The inflation data was still sticky, right?
Exactly. Core PCE came in at 2.9%. So you combine that high growth with inflation that's still above the Fed's target, and you've basically just cemented the higher for longer interest rate story.
And that story sucks liquidity out of crypto.
It replaces that speculative excitement with some pretty sober math about where to put your capital.
Okay, so if the macro picture is pushing capital out, where is it coming from? We have to look at the internal plumbing, right? The spot Bitcoin ETFs. What are they telling us?
They're telling us that the big institutional buyer has hit the pause button, and in some cases is actively selling.
How bad is it?
The whole sector just saw its fourth straight day of net outflows. We're talking about just under $189 million leaving the space. It signals a pretty big recalibration.
But the research points to one specific detail here that's really critical. It's not just general outflows, it's where it's coming from.
That is the headline. For the first time in weeks, BlackRock's iShares Bitcoin Trust, IBIT, it recorded a huge net outflow.
IBIT, not grayscale.
IBIT. We're talking $157.3 million out. IBIT has been the market's engine, right? It's been absorbing all the selling pressure from everyone else.
So when the biggest buyer suddenly starts selling, that sends a very different signal.
It raises serious questions about where the structural support for the price is going to come from in the short term. Is this panic or is it something else?
And you think it's more strategic?
Overwhelmingly, this is about the calendar. You're probably seeing two things. First, year-end rebalancing. Big funds are locking in the massive gains they made this year to report to their clients.
Makes sense.
And second, maybe some tax loss harvesting, though that's less likely given how much the price has run up. It's just classic institutional de-risking before the new year.
So not necessarily a long-term bearish sign, but maybe just institutions going on a temporary vacation.
I think that's the right way to see it. It's tactical profit taking.
Yeah.
We saw it across the board. Fidelity, Bitwise, they also had outflows. And Grayscale continued its slow bleed. The organic demand that got us here has just, for the moment, been exhausted.
It's a great point about tactical capital.
Right.
But there's this really interesting contrast here with corporate treasuries. You've got Bitmine Immersion Technologies, BMNR, doing the complete opposite.
Yeah, BMNR is making a massive high-conviction bet, but on Ethereum. They just disclosed they're now holding 4.06 million ETH.
Which is worth what?
North of $12 billion. They're basically trying to become the Ethereum proxy stock. It's the MicroStrategy playbook, just for Ether.
And what does that mean for the ETH market, having one company hold that much?
It means you have a new whale. And that's a huge chunk of the liquid supply being taken off the market and put into a corporate treasury, not a trading account. It's a huge vote of confidence that they think ETH is going to outperform.
So tactical money is selling Bitcoin ETFs, but long-term corporate money is making these huge infrastructure-level bets. That leads us right into this industrial and infrastructure pivot. Let's start with the miners. Their whole identity seems to be changing.
It really is. The old story was that miners are just leveraged plays on the Bitcoin price, volatile crypto beta stocks.
Right.
The new story is that they're becoming stable digital infrastructure companies. Just look at Cipher Mining, CIFR. They just bought a huge 200-megawatt site in Ohio.
And you said the location is important.
The site is in the PJM market, which is one of the biggest, most stable electricity grids in North America. That means reliable, cost-effective power. But here's the pivot. The announcement was explicit that the site is being acquired for high-performance computing, HPC.
So not just for mining Bitcoin, we're talking AI training clusters.
Exactly. This is the big realization for them. The miners have figured out their most valuable asset isn't their mining rigs, which get old fast. It's their power agreements. It's their spot in the queue to get massive amounts of stable energy from the grid.
And they can use that access to either mine Bitcoin when it's super profitable or rent out that power and space to AI companies for a steady, predictable fee.
That's the new investment thesis. They're turning into what people are calling digital infrastructure REITs. Their revenue shifts from being totally dependent on a volatile coin price to stable monthly contracts. It completely changes how you value them.
That is a tectonic shift. And while the miners are pivoting, the exchanges are also evolving. Coinbase looks like it wants to become the everything exchange.
They're trying to be a universal liquidity hub, and their latest move was enabling direct deposits and withdrawals of Solana, so SOL, right onto their Layer 2 network, Base.
Why is that bridge from Solana to Base such a big deal?
Well, Solana is fast and cheap, but it isn't built on the same tech as the Ethereum, the EVM.
Yeah.
And most of DeFi runs on EVM. So by creating this seamless bridge, Coinbase is basically letting capital move frictionlessly between these two giant separate ecosystems. It creates one massive liquidity pool.
A very smart structural move. And they're not stopping there. They also made an acquisition.
Yes, they bought the clearing company, which is all about prediction market infrastructure. It's a clear signal they want to offer everything: spot, derivatives, and now event contracts, like betting on elections. They're going right after platforms like Polymarket.
And speaking of derivatives, we saw Architect Financial Technologies raise a pretty big round, a $35 million Series A, and it's led by the former FTX U.S. president.
It's fascinating. It shows that capital is still willing to back proven talent and good technology, even if it comes from a troubled place.
So what are they building?
They're scaling their perpetual futures exchange, AX. But what's interesting is that it's focused on traditional asset, stocks, commodities, but using crypto's super efficient 24/7 market structure. And they're targeting non-U.S. institutions.
So it's basically using crypto tech to invade traditional finance.
It's a quiet invasion, but that's exactly what's happening.
Okay, let's zoom out to the geopolitical view, because the divergence we're seeing between East and West on regulation is just stark.
It's night and day. Let's start with Russia. The Bank of Russia just proposed a new law that would actually let retail investors buy crypto.
That sounds like a complete 180 from their old stance. What's the strategy there?
It's pure strategic adaptation. I mean, Russia's looking for any way it can to bypass global sanctions, and crypto is a part of that puzzle. But they're not just opening the floodgates.
There are limits, I assume.
Strict limits. Retail investors would be capped at about $3,800 a year. And, more importantly, they have to pass a knowledge test.
So it's a control mechanism.
It's a control mechanism disguised as education. They're opening a small valve for investment, but keeping domestic crypto payments illegal. It's a very targeted move.
Meanwhile, all the way over in Japan, they're taking the opposite approach. They're not just allowing it, they're validating the tech by using it for sovereign debt.
That's right. The Japanese government is moving to fully digitize local government bonds on the blockchain by 2026. Municipal bonds will be issued as digital securities.
And the main benefit there is just efficiency.
It's about cutting out the middlemen. Local governments can issue these bonds directly to investors, which drastically cuts down on costs and settlement times. I mean, this is one of the strongest possible validations of the technology you can get from a major government.
And then back here in the U.S., you have this competition heating up between states. Arizona just introduced a new bill.
Senate Bill 1044. It's designed to exempt virtual currency from state property taxes and explicitly protect the right for anyone to operate a blockchain node.
So they're trying to become the most crypto-friendly state for infrastructure.
It's a race for capital. They see these businesses bring high-paying jobs and, more importantly, stable energy demand. So they're removing tax friction to try and lure that infrastructure to their state.
All right, before we get to the price outlook, we have to touch on security. Because for all this institutional adoption, the risks are still very real.
Absolutely. The polymarket breach is the perfect example of this UX versus security trade-off.
So what happened there?
The core protocol was safe, but they confirmed a breach through a third-party login service called Magic Labs. So users who used a simple Web 2-style login, like with an email or a Google account, their accounts were compromised.
It's like using your Facebook login to open a bank vault. The vault was fine, but the front door was weak.
Perfect analogy.
Yeah.
And for any institution listening, this just reinforces the need for real security, like hardware wallets or multi-sig. And we also saw the SEC charge a group running a $14 million fraudulent investment club on social media. The old scams just have new clothes.
Okay, let's bring it all home. We have these strong macro headwinds. We have ETF outflows. Looking at the charts, what are the technicals telling us right now?
Well, Bitcoin is trading around $87,368. It's down a bit. And critically, it is trading below its 20-day exponential moving average,
Which is a short-term bearish signal.
It tells you momentum is with the sellers for now. The market is in what we call a distribution phase. Price is just churning sideways on lower volume.
And if this distribution breaks down, where's the price likely headed?
There's a big cluster of long liquidations building up between 85.8 and 86.5. That's where a lot of leverage buyers have their stop losses. If we lose 87,000, a flush down to that zone is highly probable.
And volatility is super low right now.
It's at 1.27%. And low volatility almost always comes before a big, violent price move. Given the current setup, the odds favor that move being to the downside.
So what's the actionable insight for you listening? What is the one level we need to watch over the next day or two?
It's all about $85,000. That's the big psychological support. If we see a strong, decisive defense of that level, and if we see the ETF flows start to stabilize in January, which I think they will, that would be a high conviction signal for the next leg up.
So wrapping this all up, what this really means for you is that the market is going through a necessary liquidity reset. It's digesting this huge run-up we've had. And seeing some of this, let's call it tourist capital, leave through the ETFs, well, it's painful in the short term.
It is. But it's also a healthy process. It clears the deck and allows for more sustainable long-term growth to build from a stronger foundation.
And I want to leave you with one final thought to mull over, connecting back to that massive structural shift we talked about.
The miners. The move by companies like Cypher to build data centers for AI, not just for Bitcoin. This fundamentally changes their business model and reduces their dependence on Bitcoin's price. So here's the question. If the very people who secure the Bitcoin network are becoming digital infrastructure REITs focused on AI, how does that functionally reprice the long-term security budget and the value proposition of the network itself?
That is a fundamental question for the future. You now have the intelligence you need for the next 24 hours. We will be back tomorrow to see how it all plays out. Thanks for diving deep with us.